GDP in the March quarter was boosted by business investment, mainly in mining and energy, of course, and mainly in Western Australia and Queensland, but also by household consumption, even though the savings rate is still high. And that's because disposable incomes are rising strongly, thanks largely, of course, to the mining boom. High consumption also seems to be a result of discounting, internet shopping and overseas travel, which is why retailers are still doing it tough. Now here's a chart of the GDP growth, and it makes a pretty neat W shape. There was the GFC slowdown, partial recovery, back down again last year, and now proper recovery back to 4.3% growth, well above the 20-year average. But the paradox is that despite all this, interest rates are priced for recession, both cash rates and bond rates. So either the market and the RBA are wrong and or stupid, or the national accounts are ancient history already. Or perhaps interest rates reflect the present global reality, but our GDP is strong because of mining investment for the future. The dollar jumped half a cent at 11:30 a.m. when the national accounts were released, and it's now up 3 cents from last Friday's low of 95.5. The share market closed a third of 1% higher, but it was hard to discern a trend. Among the resources stocks, BHP went down, Rio went up, and among the banks, Westpac dropped pretty sharply, but Commonwealth went up. And Qantas didn't bounce, it kept falling, down another 2.6%. On global markets, there was a big sell-off in Athens overnight, but otherwise most markets moved higher. There seems to be some encouragement from the fact the G7 finance ministers had a phone conference last night, even though nothing happened, and there was a better than expected services sector survey out of the United States. And that's finance.